Hello everyone, welcome to the 224th episode of me learning how to trade in Forex. In the last episode, we were going through what is a candlestick pattern. So we continued off from where we left off last time, which was somewhere around here. So candlestick patterns, which are precursors of price direction and potential reversals. Note these are time sensitive in that they only work within the limitations of the chart being reviewed, so whether that's intraday, daily, weekly or monthly. Their potency decreases rapidly 3 to 5 bars after the pattern has been completed. So with some common candlestick patterns, so we've got a doji and spinning top. Looks like this. So both doji and spinning tops suggest indecision in the market, and that indecision will evaporate as new price direction will be forthcoming. We then went through the bullish, bearish, engulfing lines. So engulfing line is a strong indicator of a directional change. Bearish engulfing line is a reversal pattern after an uptrend. The second day's candlestick body engulfs the prior day's body in the opposite direction. So a green one engulfing a red one, or a red one engulfing, bearish one, red one engulfing the green one. Yep, okay. So it engulfs the prior day's body in the opposite direction. This suggests that for an uptrend, the buyers had a brief attempt higher, but finished the day well below the close of the prior candle. This suggests the uptrend is stalling has begun to reverse lower. Bullish engulfing line is a reversal pattern after a downtrend. The second day's candle body engulfs the prior day's body in the opposite direction. So this is one where the green one devours the red one. This suggests that for a downtrend, the sellers had a brief attempt lower, but finished the day well above the open of the prior candle. This suggests the downtrend is stalling and has begun to reverse higher. And we've got the hammer, so suggests that the down move's ending, hammering out at the bottom. Note that the long lower tail, so the important interpretation is that this is the first time the buyers have surfaced in strength in the current down move, which is suggestive of a change in the directional sentiment. Pattern is confirmed by a bullish candle in the next period. Got the hanging man, so suggests an important potential reversal lower. For the first time in many periods, selling interest has entered the market, which leads to a long tail in the downside. Confirmation of the pattern comes with a red candle on the following day. And then we got abandoned baby top / bottom, so also called an island reversal. Abandoned baby is a significant pattern suggesting a major reversal in the prior directional movement. An abandoned baby top forms after an up move, and an abandoned baby top bottom forms after a down move. Pattern includes a gap in the direction of the current trend, leaving a candle with a small body, so spinning top or doji, all alone at the top or bottom. Confirmation comes on the next day's candle where a gap lower, so abandoned baby top, signals that the prior gap higher was erased and that selling interest has emerged as a dominant market force. Confirmation comes with a long dark candle the next day. So small bodies represent indecision in the marketplace over the current direction of the market and can be frequently seen as a reversal indicators. Therefore, either bulls or bears will win out eventually, so watch the price behavior and be prepared. Also watch out for long tails, especially when combined with short bodies, as long tails represent an unsuccessful effort of buyers or sellers to push the price in their favoured direction, only to fail and have the price returned to near the open. So that's what we got for the last time. So carry on from that, which candlestick pattern is the most reliable? Many patterns are preferred and deemed the most reliable by different traders. Some of the most popular are bullish bearish engulfing lines, bullish bearish long-legged doji, and bullish bearish abandoned baby top and bottom. In the meantime, many neutral potential reversal signals, e.g. doji and spinning tops, will appear that should put you on the alert for the next directional move. Does candlestick pattern analysis really work? Yes, candlestick analysis can be effective if you follow the rules and wait for the confirmation, usually in the next day's candle. Traders around the world, especially out of Asia, utilize candlestick analysis as a primary means of determining overall market direction, not where prices will be in 2 to 4 hours. That's why daily candles work best instead of shorter term candlesticks. Right, okay, so determining overall market direction, not where prices will be in 2 to 4 hours. So, not good for short term candlesticks, only to see the overall trend, not predicting where prices is going to be in 2 to 4 hours. Asian traders use utilize candlestick analysis of prime means. Okay. It's not CN. Asian traders utilize candlestick as a means. Utilize candlestick analysis as a primary means. Utilize candlestick analysis as a primary method to determine the overall market direction. Not where prices will be in 2 to 4 hours. Not where prices will be in 2 to 4 hours. That's why daily candles work best instead of shorter term candles. Okay, how do you read a candlestick pattern or candle pattern? Candle pattern is best read by analyzing whether it's bullish, bearish or neutral indecision. Watching a candlestick pattern form can be time consuming and irritating. If you recognize a pattern and receive confirmation, then you have a basis for taking a trade. So be careful not to see patterns where there are none. Let the market do its thing and you'll eventually get a high probability candlestick signal. So don't force a pattern to appear when there isn't one. So candle patterns are best read by analyzing whether it's bullish, bearish or neutral. Watching candlestick pattern form can be time consuming and irritating. If you recognize a pattern and receive confirmation, then you have a basis for taking trade. Be careful not to see patterns where there are none. So don't force a pattern to be seen. Let the market do its thing and you eventually get a high probability candlestick signal. Bottom line, candlestick analysis has been around for centuries and worked for the same reason as other forms of technical analysis, because traders follow it. Candlesticks can be combined with other forms of technical analysis such as momentum indicators, but candles ultimately are a standalone form of charting analysis. Daily candlesticks are the most effective way to view a candlestick chart as they capture a full day of market info and price action. If you opt to use the shorter term candles, be cognizant that their meaning lasts for a few of the periods that you use. For example, a 4-hour candle pattern is only valid for around 4-hour periods. Candlestick signals come in individual candles, e.g. doji, as well as multiple candlestick patterns, like bullish bearish engulfing lines, bullish bearish abandoned babies, and bullish hammers / bearish hanging man patterns. Candlesticks are great forward-looking indicators, but confirmation by subsequent candles is often essential to identifying a specific pattern and making a trade based on it. In particular, candlestick patterns frequently give off signals of indecision, alerting traders of a potential change in direction. So confirmation candles is often essential when identifying patterns. Cool. Okay, so we've got another guide here, part of a series, Guide to Technical Analysis. This is Guide to Technical Analysis as well. About this, is this a Guide to Technical Analysis as well? Ultimate Trading Guide? Nope. Guide to Technical Analysis. Okay, so I'm going to put all the guides to technical analysis together. So, Guide to Technical Analysis. This is the one we just done. Yep, okay, so Advanced Candlestick Patterns. Advanced Candlestick Patterns. Candlestick patterns provide insight into price action at a glance. While the basic candlestick patterns may provide some insight into what the market is thinking, these simpler patterns often generate false signals because they are so common. Below, we will look at more advanced candlestick patterns that offer a higher degree of reliability. These include the island reversal, hook reversal, three gaps, and kicker patterns. So island reversal pattern. Island reversals are strong short-term trend reversal signals. So strong short-term trend reversal signals. They are identified by a gap between a reversal candlestick and two candles on either side of it. So identified by a gap between a reversal candlestick and two candles on either side of it. Here's a bullish example. The price is moving down, gaps lower, then gaps up and continues higher. So identified by a gap between a reversal candlestick. So this is the doji, I think. Looks like to be a doji. Got a hanging man here. Hanging man. This is hanging man. Yep. So hanging man suggests a downside reversal. It's got a reversal candle here by a gap between a reversal candlestick and two candles on either side of it. Here's a bullish example. So got a red doji reversal gap. So gap here, and then a reversal candle again, a gap, and then price going up. So bullish example. So bullish island reversal. The price is moving down, gaps lower, then gaps up and continues higher. Below is a bearish example of the same pattern. Candle here, gaps into a spinning top or a doji, a gap, and then into another indecision candle. So spinning top or a doji, and then goes down. Entry. The island reversal shows indecision and a battle between the bulls and the bears. This is often characterized by a long-ended doji candle that has high volume occurred after an extended trend. It is after the gap and move in the opposite direction that a trade is taken. For the bearish pattern, enter short after the gap and move in the opposite direction. For the bullish pattern, enter long after the gap and move in the opposite direction. So island reversal shows indecision and a battle between the bulls and the bears. Shows indecision and a battle between the bulls and the bears. This is often characterized by a long-ended doji candle that has high volume occurring after an extended trend. So often characterized by a long-ended doji candle that has high volume occurring after an extended trend. That has high volume occurring after an extended trend. It is after the gap and move in the opposite direction that a trade is taken. So after the gap and move in the opposite direction, take the trade. After the gap and move in the opposite direction, for the bearish pattern, so for bearish island reversal, enter short after the gap and move in the opposite direction. Enter short after the gap and move in the opposite direction. So in this case, enter short after the gap, so after this bit here, and move in the opposite direction. So after it's begun to move, enter here, because this is like sort of a confirmation set of candles, and move in the opposite direction. For bullish island reversal, enter long after the gap and move in the opposite direction. For bullish island reversal, enter long after the gap and move in the opposite direction. For the bullish pattern, enter long after the gap and move in the opposite direction. Exit. An exit refers to both the target and the stop loss. With this pattern, you want to capture the thrust in price that follows that pattern, but once that thrust starts to weaken, it's time to get out. If the price moves back to fill the gap, then the reversal pattern is invalidated. So if the price moves back, so if the price went up again like that to fill the gap, then the pattern is invalidated and you should exit right away. Therefore, a stop loss can be placed in the gap or near the island candle. So place it somewhere in here or somewhere around here. Capture, but once that thrust starts weak, it's time to get out. So if the price moves back to fill the gap, then the reversal pattern is invalidated and it's time to get out. Therefore, stop loss can be placed in the gap or near the island candle. So the stop loss can be placed in the gap or near the island candle. Hook reversal pattern. Hook reversals are short to medium term reversal patterns. Hook reversal pattern. Short to medium term reversal patterns. They are identified by a higher low and a lower high compared with the previous day. So identified by a higher low and lower high than the previous day. Here are bullish and bearish examples of the patterns. So we got they're identified by a higher low and a lower high. Higher low, so this candle compared with this candle, so this candle's wicks has a higher low, so the low for this candle is here, whereas the low for this candle is here, so this candle's low is higher than this candle, and a lower high, so this candle's high is over here, whereas this candle's high is over here, so this candle's high is lower than this candle's high compared to the previous day. So here are some bullish examples of the patterns. Same with this, so what is it? Higher low, so this candle compared with this candle. This guy, this is the first candle's low, this is the second candle's low. Second candle's low is higher than the first candle's low, and was it a lower high? So can't really see it that well, but I'm assuming that one's higher. No, that one's higher than the other one. So yeah. Bullish, okay. Bearish, bearish hook reversal. Entry on the bullish pattern, there is a downtrend followed by 2 up days. Downtrend followed by 2 up days. The first or second up day breaks the high of the last down day. So on the bullish pattern, there is a downtrend, so downtrend like that, followed by 2 up days. By up, do they mean the green? Or do they mean the 2 up days as in these 2 candles here? But that one is an up candle, that's a down candle still. The first or second up day breaks the high of the last down day. So this one breaks the high of the last down day. It is a second up day when a long trade should be taken. So go long on this one here, which makes sense, as the pattern indicates that the price could continue to rally. No, on a second up day, so on this second one here, right? Wait, followed by, on the bullish there is a downtrend followed by 2 up days. So these 2 up days, the first or second up day breaks the high of the last down day. So either this one, this one's high is higher than this one, or this candle's high is higher than this one. So you can see that the second candle's high is higher than the down candle's high here. It is a second up day when the long trade should be taken, as a pattern indicates that the price could continue to rally. For the bearish pattern, okay, so for the bullish pattern, there is a downtrend followed by 2 up days. I don't know if this description is for general or is it just for this specific example. So what if there's only like 1 update? Does that mean it's not a, what is it, hook reversal pattern? Or followed by 2 up days. So the first or second up day breaks the high of the last down day. Breaks the high of the last down day. So the first or second red-green candle breaks the high of the last red candle. It is a second up day when a long trade should be taken. Take a long trade at the second up day, so at the second green candle, as the pattern indicates that the price could continue to rally. For the bearish pattern, on the bearish pattern, there is an uptrend followed by 2 down days. So there is an uptrend followed by 2 down days, and either the first or second down day breaks the low of the last up day. So the first or second down day breaks the low of the last up day. Take a short position, take a short trade at the second up down day. Followed by 2 down days, and either the first or second down day breaks the low of the last up day. It is the second down day on which a short trade should be taken, as the pattern indicates that the price could slide lower. Exit. Know your exit points before trading this pattern. In most cases, you will see a sharp reversal as shown in the chart above. So sharp as in whoop, 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 whoop. Anything to the contrary indicates that the pattern is not working, so exit immediately. Therefore, a stop loss can be placed above the recent high for a bearish pattern. So put a stop loss around here, or below the recent low for bullish. For bullish one, place a stop loss around here. We can't know how long the reversal will last based on the pattern alone. Therefore, maintain the trade for as long as the price is moving in the expected direction. When a move weakens or a pattern in the opposite direction occurs, take your profits. So In most cases, there will be a sharp reversal for the bullish and bearish hook reversal. Anything to the contrary indicates that the pattern isn't working, so anything other than that shows the pattern isn't working. So exit immediately. So exit immediately. Therefore, a stop loss can be placed above the recent high for a bearish pattern or below the recent low for a bullish pattern. So the stop loss can be placed above the recent high for a bearish pattern or below the recent low for a bullish pattern. We can't know how long the reversal will last based on the pattern alone. So there is no way in knowing how long the pattern will last based how long the reversal will last based on the pattern alone. Therefore, maintain the trade for as long as the price is moving in an expected direction. So maintain the trade for as long as the price is moving in the expected direction. When the move weakens or a pattern in the opposite direction occurs, when the move weakens or a pattern in the opposite direction occurs, exit the trade. Sanku 3 gaps pattern. The Sanku pattern is an anticipatory trend reversal signal. Anticipatory trend reversal signal. Sanku 3 gaps, wrong word there. 3 gaps pattern. Sanku pattern is an anticipatory trend reversal signal. So an anticipatory trend reversal signal. The pattern does not indicate an exact point of reversal, so doesn't indicate an exact point of reversal, rather indicates that reversal is likely to occur in the near future. It indicates that a reversal is likely to occur in the near future. The pattern does not indicate an exact point reversal, rather indicates that reversal is likely to occur in the near future. Doesn't indicate doesn't indicate an exact point reversal, it indicates that a reversal is likely to occur in the near future. The pattern is created by 3 trading sessions in a row with gaps in between. So pattern created by 3 trading sessions in a row with gaps in between. While each candle doesn't necessarily have to be large, usually at least 2 or 3 of the candles are. So each candle doesn't have to be large, but at least 2 or 3 of the candles are. But usually at least 2 or 3 of the candles are. Here is a 3 gaps pattern that signal the end of an uptrend. The price is accelerating higher. There are 3 gaps higher in a row. Since such momentum can't last forever, the buyers are eventually exhausted and price moves the other way. Signals the end of an uptrend, so the price is accelerating higher, boom, 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 boom. There are 3 gaps higher in a row. Oh wait, so the price is accelerating, there are 3 gaps higher in a row. 1, 2, 3. But why are they gaps though? How are they gaps? What, because there's a gap? So if we draw a line here and then draw a line here, there's gaps between here and then there's gaps between here. So that's a gap. Because for this one there isn't a gap here, right? So it's all connected and stuff. Okay. Higher in a row. Since such momentum can't last forever, the buyer is eventually exhausted and price moves the other way. So because it's a green candle, it closed above the opening price, so the closing price is here, the opening price is here, so this candle shows that the closing price is here, opening price is here, and then this candle shows that the closing price is here, the opening price is here. So it opened higher than when it closed, and then this one also opened higher than when it closed. This one opened higher than when it closed, but then for this one opened below where it's closed. So the momentum has been lost. And yeah. So its price accelerating higher. Here's the 3 gaps pattern that signal end of an uptrend. Price is accelerating higher. There are 3 gaps higher in a row. Price is accelerating higher. And there are 3 gaps in a row. 3 gaps higher in a row. Since such momentum can't last forever, buyers are eventually exhausted. Momentum can't last forever, so the buyers are exhausted and price reverses are eventually, because remember that we don't know exactly when the reversal is going to occur, likely to happen in the near future, so it could have occurred somewhere over here. Entry: this pattern operates on the premise that the price is likely to retreat after a sharp move because traders will start taking profits. This pattern operates on the basis that the price is likely to retreat. Price is likely to retreat after a sharp move as traders will be starting to take profits. For additional evidence of the possibility of reversal, look for extremes in the relative strength index or await a crossover of the moving average convergence divergence, or MACD. So use other indicators to confirm the theory, basically. So use other technical indicators as a confirmation of a use other technical indicators as confirmation of a trend reversal. As confirmation for the possibility, use other technical indicators as confirmation for the possibility of a trend reversal. Exit. This pattern anticipates a reversal. If it doesn't happen, get out of any trade that was taken because of this pattern. Price must follow through in the anticipated direction in order for the signal to be valid. If no reversals happen, get out. Price must follow through in the anticipated direction in order for the signal to be valid. Price must follow through in the anticipated direction for the pattern to be valid. Stop loss orders can be placed above the high of the pattern if going short. So stop loss can be placed above the high of the pattern if going short. Ride the downward momentum whilst it lasts. Since it is unknown how long the sell-off will last, take profits when you see a reversal signal in the opposite direction or when the selling momentum slows. Ride downward momentum whilst it lasts. Take profit when you see a reversal signal in the opposite direction. As it's unknown how long the sell-off will last, take profit, so exit the trade when you see a reversal signal. Exit the trade when you see a reversal signal in the opposite direction or when the selling momentum slows. Use get out. Price must follow through in the anticipated direction for the pattern to be valid. So in this case, this one must go down for the direction to be for the pattern to be valid. Stop loss can be placed above the high of the pattern. So stop loss can be placed above here. If going short. But then there's another one. How do you know how long? Because this pattern doesn't tell you when the reversal is going to happen. It just indicates that reversal is likely to happen in the near future. What if the price kept climbing up and you don't know when exactly it's going to go down? So I don't think placing the stop loss above the high of the pattern, so above here, if going short, works. Because in this case, right, for this example, place a stop loss here, then you're instantly, where do you enter actually? Entry. Alright, you have to use other patterns to, other technical indicators to confirm your entry. So you don't really even know when to entry using this pattern alone, so you have to use other indicators. But say if the other indicators tells you to enter here, then the price went up here, then the pattern just becomes invalidated because price must follow through in the anticipated direction, which is down, for the pattern to be valid. So instantly invalidates the pattern and you have to close the trade. But then the downward momentum comes. I don't really know about this one, to be honest. Yeah, I have to use other patterns to other technical indicators to confirm this, so it won't work on its own basically. That's all I have to say. I am going to leave this episode here. So thank you all for watching, and I shall see you all in the next video. See you later.